To the Smart Investing Show, sponsored by the SEC-registered investment firm Wilsey Asset Management, a fiduciary firm owned and operated by President Brent Wilsey, who's been putting client needs first for over 40 years. The Smart Investing Show has been giving unbiased financial information for over 27 years on local radio stations right here in San Diego, providing you with fundamental analysis on stocks and investments you want to know about. Now, here are your hosts, Brent and Chase Wilsey.
Well, hello and welcome to the Smart Investing Show. I'm Brent Wilsey, president of Wilsey Asset Management. Great to have you here today. Let's see what we're talking about today. We got some great topics as always. This just happened this past week. The U.S. received a downgrade to its credit rating. Should you be worried about that? We'll talk about that and go over that for you. I hated when I saw this, and that's why we want to talk about it, was the high risk private market investments are showing up in more 401k plans. I think it's a terrible idea. We're going to talk about it and what you need to watch out for. And this one was kind of I guess not surprising. Oil prices are falling, gas prices are falling, but demand for electric vehicles, well, that is falling. We say dramatically. We'll explain why. Chase, what do we got for companies today?
Yeah, so companies we're going to take a closer look at include CAVA, the restaurant chain there, the Mediterranean food spot. We'll kind of dig down into the numbers there. We'll look at First Solar, Levi, Strauss, and also to UnitedHealth. And UnitedHealth's interesting because we looked at this about a month ago. But there's still just been so much news in the last month. I'm like, I think we should look at it again. So excited to take a look at those four companies, give you our opinion if we think it's buy, sell, or hold based off the numbers we see on there.
And I think since last month, it has fallen more, correct?
It's down about 25-30% since we looked at it last month.
And I did see some analysts switch over to the buy side, thinking, maybe enough's out of that. But we're going to go with the numbers to make sure people understand the company, and maybe it's a good buy. We'll look at the numbers for you. Let's talk about, let's see. Well, I flipped my things around here. I said I want to talk about the U.S. just received a downgrade to the credit rating. Should you be worried? Because it was kind of frightening when it came out, like, oh, my gosh. But, last week, Moody's, who announced the downgrade to United States sovereign debt rating. And this is hard to say. It's big A, little a, because it's not a triple A. What Moody's does is they have a difference between a capital and a regular A.
Yeah, the way I said it when I was on Fox 5, I still called it AAA just because it's simple. Yeah. It is the highest rating, though. Well, it's not like 3 big A's is not better than 1 big A and 2 small A's. It is the highest rating.
I just like S&P. Much better just you got the
AAA.
A's. Yeah, AAA. But this is I'll say AAA. They reduce it down to a AA1. So it's just below that. While it's a downgrade, it is important to understand and can have negative consequences for the interest rates on the debt. This downgrade, it's almost so late to the party. It seems like when it came out, I guess that's bad. But and they do have rules as far as what they're going to downgrade it for. But it just seemed like everybody else was down. You're the last one to the party. Why the delay?
Yeah, and we'll kind of talk about the other downgrades that had already occurred. And again, there's 3 major rating entries. You already talked about Moody's, you talked about S&P, and also the last one is Fitch. Well, Standard & Poor's, or again, S&P, was the first major credit rating agency to actually downgrade the U.S. debt. But again, as you said, were they late to the party? And the reason you say that is the Standard & Poor's did this in August 2011. We're about 14 years later now here. It's kind of like, what?
There's people weren't in the finance market back 14 years ago.
No. The thing you look at is the reaction to that move from Standard & Poor's. That scared people.
Yeah.
The stock market, that fell about 6.7% the day after the announcement of the downgrade.
And I think what the concern has been is that there is concern going forward that the debt's going to rise. And I feel when I look at this and I read this, I just don't think they're giving any credit to what I see as a growing economy going forward. You hear about all these big deals we're having with people investing in our country, and you hear about all these positives, the labor force. And I think they're looking at that the growth is going to stay the same, but with higher debt. And I don't think they're taking into account the tariffs. But we're going to see how this develops. And I think it's an overreaction to it as usual. But I think it'll be fine. And Fitch, well, they lowered their rating on U.S. debt back in August of 2023. The stock market, when that happened, it only lost 1.4%.
Yeah, and then the last piece of the puzzle here, so to speak, again, we talked about how Moody's downgraded it. Didn't even move the needle. The stock market actually went up on Monday, which is the day after stock trading essentially took place, the day after the downgrade occurred. Because I think it occurred Friday after stock trading last week. So, I mean, again, not a very big impact. And the way I look at this is it is concerning. And I talked about this when I was on Fox 5 the past week. And the reason it is, I mean, and this is a worst case scenario, right? But the reason you want to have strong debt ratings is you want your debt to be attractive. And the reason that's so important is if your debt is unattractive, people aren't buying it. The debt market is supply and demand based. So if nobody's buying your debt, what has to happen if your interest rates have to go up to then meet new demand and bring people in to buy your debt? But if your interest rates are rising, what does that mean? Your mortgage rates are skyrocketing, your auto loans are skyrocketing, your credit card rates are skyrocketing. That is the problem if the debt continues to have issues. But as I said, I do agree with you. I think this is a huge overreaction.
And we got to remember that the U.S. debt, well, it's still considered very safe an investment, very safe asset. With that said, the U.S. does have to do something. We can't go on the same path we're on. As I said, I do believe the revenue side, the growth of the economy will continue to increase, which kind of help offset this. But we got to do something to reduce the deficit problem, because if we don't, there could be further downgrades from the credit agencies down the road, which would be a problem. I don't see that happening. I think, again, a lot of things I'm reading and seeing. I think right now, this summer, we're going through the most difficult part. And after that, fall, I think we're going to start seeing some clear horizons that go through fall in 2026. And I think things look pretty good going forward.
Yeah, I mean, obviously you have your concerns, and the big one is you have two parties, right? Democrats, Republicans, and they're trying to come together here on this tax bill. And the issue that you have is you have to make deals.
Yeah.
But to make deals, nobody's talking about making deals to cut benefits and raise taxes. It's, okay, well, give me a little bit more of the benefits, and then, okay, we'll give you a little bit more of a tax cut. Well, while you're right, you're going to have maybe growth to GDP. I am hopeful that maybe they are a little bit tighter than what people are expecting, because they don't want to be over restrictive where you all of a sudden lose GDP growth, but you also don't want to come out willy-nilly and be like, yeah, we're just going to goose the economy along. We're going to cut taxes. All the benefits will stay the same. That would be a problem in my view. And I think you've seen the 10-year kind of react a little bit negatively to talks around this tax bill, because people are a little bit worried about the deficit. And my hope is that, maybe we get a little bit more that is not loosey-goosey, I'll call it, and then that 10-year can kind of rein back in somewhat.
Is that a technical term, loosey-goosey?
Loosey-goosey, yeah. It's, learned it in finance school, actually.
Did you really?
No.
Hey, you never know. I mean, they could have. And actually, I do have I've been reading, and I'll summarize this in a post for people probably in the next week or two. But I've been reading, when you compare our country, our economy, our growth compared to Europe, I was shocked at some of these numbers. We're not talking just a few years. We're talking many, many years that we've done extremely well. I'll tease with that and say, just stay tuned. Make sure you sign up for the newsletter. We'll probably talk about it here on air. But we're going to be fine. I'll put it that way. So
I'm not worried. And again, being still AA, it's very safe debt. It's not like, oh my gosh, we're junk status. I mean, we are so far from that, and we would have to have serious issues.
Yeah.
And I just don't see that happening. I don't want to say I don't care about the debt rating downgrade, but very little impact into how I view the economy, how I view the stock situation. Uh-oh.
Okay, there we go. I think I cut out my microphone. Or did you cut out my microphone? Priscilla is right on top of it. She does a great job. So, well, let's move on here. Talk about the high-risk market, private market investments, which we've never been in favor of. I think they're a great deal for real estate, but not a great deal for the investors. But now they're going to start showing up in 401k plans. Empower oversees about $1.8 trillion in 401k assets for about 19 million people. So I think all these 19 million people are going to have to decide if they're going to be investing in, and what they're going to start allowing is private credit, private equity, and private real estate in some of the accounts that they administer later this year. And that just worries me, because private means you don't know what's going on. You're not going to see the market price. And we've dealt with this for years with people that got sold this by somebody else and come over, and what a nightmare it is. I'm very disappointed. I've seen some articles in the Wall Street Journal they're disappointed with, but it's all a fee grab for these I'm going to say greedy companies that want more fees and really don't care about their participants in their 401ks.
Well, I mean, it's just something that we've seen the back end of it, and it's a pain. And I'm so curious what is going to happen here, because generally, right, you have your 401k. You leave your employer, you take it to maybe your new 401k, you put it in an IRA rollover. Well, are you going to be able to move it? Is Empower doing
Good
this?
point.
Maybe because it's like, hey, that new company, they don't even accept that alternative investment, so they can't move it. I mean, we've had this happen where, we custody our assets at Schwab. Schwab says, we don't accept that alternative investment. We don't accept that private credit investment. That could be very problematic in moving your 401k along with you. I as you said, I'm very disappointed by this. I think there, frankly, is very little upside. And I want to say this lightly, but people have made money off private investments. I don't want to say they're all bad, but there's a lot of bad ones out there. And the big problem is many times investors, they make no money from them. And the big problem is they can only get out a little bit of their money at a time while they are suffering from low returns and high fees. And we've seen this time and time again. We've had clients come over, and one comes to mind. He came over about 4 years ago now. He had, I think it was 5 alternative investments. He now has 3 left. So we've been able to get out of 2, but can't get out of 3 other ones.
Oh, 3 other ones. Okay.
Mm-hmm. Yeah. So he came with 5.
5. Okay.
So whoever his advisor was previously made a very nice commission, I'm sure. And then he also brought over these things called interval funds. Kind of getting a little bit off topic here, but these are like mutual funds. But again, you can only sell every quarter, and they limit the redemptions. And we've been trying for the last 4 years to get him out of these 2 interval funds. And I think the last time he's got about 200 shares left. Last time they sold about 10 shares for us.
Geez.
And it's just continuously illiquid. You're not able to get out of them. And that is the big problem with, again, went on a little bit of tangent here on the interval funds, but these illiquid investments, you want to get out, you can't. The market turns sideways on that particular investment, you can't get out. All of a sudden, let's say you're in student housing. Well, maybe college enrollment drops dramatically. Oh, well, too bad. You're in this private investment. You can't sell out of it. I mean, so many problems here.
And again, Chase, you brought up a good point that, you get laid off, you quit, find another great job somewhere else. Now you got this problem to deal with this private equity, this private real estate, private credit, whatever it may be. Or you retire and you want to roll over your money. What? Oh, I can't roll that over, And then the fees they have to pay to keep it many times is ridiculous.
That, and also too, let's say you're RMD age. We've had this happen before as well with clients. They have a carrying value on this alternative investment of, let's say, $200,000. Their portfolio is maybe $400,000. Well, they have to take their RMD off of the full $400,000, even though half of it is in this illiquid investment. So now you have to take from your other investments that are potentially performing better to cover the RMD based off of this illiquid asset. I mean, it is just a nightmare in many cases. I don't know why people do these things. And the upside, let's even say, I'm going to give it the benefit of the doubt. Let's say that private investments do 10% per year. Well, if stocks do 10% per year, why would you lock up your money? It just doesn't make sense.
And the reason why is that these are sold by brokers, by salespeople, I'm going to say, because Wall Street loves these. I mean, these private market investments, the fees, they range anywhere from 1% to 2% of the portfolio balance on an annual basis. And this is not a real market value. It's the value they put on it. So on the high side, they're getting 2%. We don't even charge anybody 2% for our management fee. I mean, it's ridiculous what they get for this, and you're not even getting any benefit from it. And again, the RMD thing you brought up was a great topic, a great point as well.
And you guarantee that fee. Again, somebody's not happy with our management after a year, they leave us. Yeah. It doesn't happen very often. We got a very good retention ratio. Most of our clients like the way we manage money. With a private investment, you're like, gosh, this is not what I thought it was going to be. Well, you can't get out. So they guarantee still they get to collect their 2% every single year until they decide they're ready to liquidate that potential investment. I mean, it's just, I don't know. I'm just, again, as you can probably tell, not an advocate of these. And one thing also that really scared me about this was one way they are trying to sneak in these private market funds is with a 10% allocation of the popular target date funds. And I've heard this from other people, including Larry Fink, who's the CEO of BlackRock, I think it is. He's either Blackstone or BlackRock. I'm pretty sure he's BlackRock. And he's like, no, the old 60-40 model's dead. And you hear this from other people. It's now 60-30-10, where it's 60 equity, 30 bonds and 10% alternatives. I don't understand why, but it seems like more people are subscribing to that. And actually, I do understand why. He makes more money because you're putting money in the alternative investments.
And, they always come up with that. You brought up 10%. Put a 60, 30, 10. Well, then you got people, well, gosh, you need gold in there too, so add 5% for that. Oh, wait, crypto, put 5% there. Before you know it, you don't have the good investments of equities, which have done very well over the long term. If you understand what you're doing, eventually you have so many things and so many different products that your return is going to suffer by that. I believe will increase the fund's risk and lower the returns going forward. It's just not worth it. And I hope everybody sees this and says, no, that makes no sense to me either. I'll either do equities or I will do bonds or I'll do money markets. I'm going to stay away from the cryptos, going to stay away from the private equity, credit, and real estate private. All private.
Well, it's kind of funny. I was talking to our financial planner Harrison the other day, and I was like, people are so funny because they'll do so well in their 401k for, let's say, 20, 30 years of their working years by doing what? Not looking at it and buying stocks. Then all of a sudden, they retire, or they're like, I should take control of my finances and look closer at my 401k, and then they mess it all up, and their returns are worse. It's like if you just buy good quality stocks for the long term, you'll do great.
And I've been doing this for 40 years. I've seen all these things. I was back in limited partnerships years ago, back in the 80s, and they were the best thing. Wall Street always comes out with these best things for you. I've seen it all. What works best? Equities, bonds at the right time, and money markets at the right time. So a good investment portfolio. Well, let's move on. Talk about demand for electric vehicles is falling dramatically. And I put that on there. And I say that because electrical vehicle sales in the month of April, they declined 5%. Well, that doesn't sound like a whole lot, but when you compare it to the overall car market, now that grew 10%. So that's a big difference from there. And this is the only third monthly decline in 4 years electric vehicles. So it's not happened a lot, but I think things are starting to change, and it's just something that I think we're going to see a change with. And I did a segment on KOSI this past week about oil dropping to $50 a barrel. I think we talked about it last week on the podcast. I think that's going to change people's direction as well. Like, why should I buy an electric vehicle?
Yeah, I mean, there's a lot of things to kind of look at here with the EVs. And one thing as well, I mean, consumers are, while they're still spending, we've talked a lot about this, the consumer is not disappearing. No. I think they are slowing. But again, slowing from a high pace is not declining. It's, again, we'll use that word a lot, decelerating. And decelerating is not bad because you're still getting growth out of it, but they are a little bit more cognizant on where they're spending their money. And a lot of the deals on EVs and the promotions, and now especially with this potential change in the tax bill disappearing, well, now people are like, the deal is not as good on EVs as it once was.
Yeah, and and I want to point out, it's not just Tesla, because people think, it's Tesla because Elon Musk, he had that political association, which really destroyed, people buying Teslas. I think he lost half his market. Yeah. People didn't vote for President Trump, obviously. But it even hit Kia, Hyundai, and Ford. They also experienced drops. Rivian was hit the hardest. They have a pickup truck called an R1T. I think that's the only truck they have, but that's what
they have. The SUV and the truck right now.
Okay, so it's trucks. So they have one pickup truck. They saw a decline of 50% of sales in April. That was a huge. That's half their market. What happened? And it's funny. The stock, I think it dropped last month, back up again, but they had a major problem. I'll be interested to see. We'll probably get them. I think the first week of June. Sales in May, what they are. I think it's going to be the same thing.
Yeah, no, and I know some don't report every month. Like, I think GM only reports quarterly numbers now. I don't think they report monthly sales. I could be incorrect on that, but I don't believe every automaker reports monthly numbers. But I think Rivian does, if I'm not mistaken. So we'll see what that kind of looks like. And I kind of talked about this as well, but we talked about how a lot of the deals are gone, essentially, when it comes to these EVs. But the other thing, too, and we've talked about this a lot with people when they are buying EVs, a big holdup is the charging of them. Yeah. And I was talking about this personally. I mean, you and I were talking today, and I'm like, gosh, I saw a Hummer on the street the other day, and I'm like,
beautiful
it's a
car.
Beautiful car. And I'm like, man, I think Hummers are really cool. And I kind of in the market maybe for a new truck. And I'm like, I don't want an EV though. I don't want to have to worry about like, I got to charge it. I got to go find a charging station, or how much am I paying on my electric bill now because I don't have solar on my house. The gas station is just so easy that I'm like, if they came out with a ICE or an internal combustion engine Hummer, I'd be much more likely to buy that. But since it's an EV, I'm like, it's not even on my radar right now. And a lot of other people feel the same way. When they were asked in a survey, they said, I don't want to worry about charging. The gas station is so much simpler.
I think it's, I'm going to make this up. I think it's a charging phobia. You are so afraid of running out of charge, which I get it.
Yeah.
Because you run out of charge, how do you, I guess the car would have to be towed.
It'd have to, yeah.
Yeah.
I mean, because you can't go get a canister of gasoline and fill it up.
Well, if it does do that, but if you have a gas car,
That's what I'm saying. Yeah, you can't go get gasoline and fill up your EV. That's not going to work.
you call AAA. No, sorry, electric vehicle. We'll have to tow it. But again, it is a concern for people that they're worried about. The charging. And I do want to point out this is only 1 month of electric vehicle sales, and it's not a trend, and that's gonna be for a while. But with the increased production, as I talked about this earlier, of OPEC from oil, they're going to increase by 1 million barrels a day. A large supply of oil is coming on the market. Gas prices should decline, and it just takes away that incentive. And I think the number was right now, not here in San Diego, not in California, but nationwide, the average cost of a gallon of gas now is like $3.20. If oil hits $50 a barrel, they're talking about hitting $2.50 a gallon. So why would you go in an electric vehicle? And I think as long as President Trump's in office, I think oil is going to be in a good command position.
Well, they want to drill, and they know OPEC now is that they're like, OPEC's kind of looked at saying, well, we need to fight for market share. So now they're drilling more. I mean, it's all a benefit essentially for oil prices and the consumer at the end of the day. And, electric vehicles tend to have a premium over the ICE vehicles. So you kind of need that disparity between, well, you're saving money on the charge versus filling up your gas tank. But if that disappears, it's like, well, now the ICE vehicle is much cheaper.
Yep. All this information comes on our newsletter, the Smart Investing newsletter. It goes out every Friday at 5 o'clock. Other topics there would be U.S. air traffic control systems need to be updated and repaired. I saw this. It was terrible. I got to read about that. Coinbase to pay out $400 million for a hack. Who should be responsible for recycling? The company producing the product or the consumer? You read that. Let me know your opinion. War weapons. Well, they've changed dramatically over the last few years here. And what makes In-N-Out Burger so successful? That was a personal observation. I think it's very interesting. You should read it. It was a Harvard business study as well back in 2003. And UK luxury cars, well, they're hurting and likely won't get any better. And if you like those Range Rovers, that's a British car. So go to our website, smartinvesting2000.com. Again, that's smartinvesting2000.com. Sign up for the newsletter. Go out every Friday at 5 o'clock. You'll see it in your in-basket. All right, what are we going to talk about here? We're going to talk about a restaurant, CAVA. And you said the Mediterranean restaurant.
Mediterranean food, yeah, I like it.
Have you been there?
Yeah, I've been there several times. It's actually one of my favorite, call it fast casual, where you don't necessarily do a drive-through, but you're not served. So it's kind of like Chipotle, where you go in, you go through the line, and you pick what you want. It's a good restaurant. I like it. It's good food. I haven't really been eating at restaurants as frequently as I used to, though. I guess a 1-year-old will do that too. Yeah.
And one on the way.
Yeah. So it keeps you busy. But I think it's a good. I think it's a good restaurant. Good food. I like the taste. I love Mediterranean food. I would definitely go back there, I'd say the least.
Well, let's run over some numbers, see if you should invest in the company as opposed to just eating there. CAVA restaurant symbol, CAVA. They're in the restaurant industry. Wow, high short on the float, 9.1%. That's pretty high for a restaurant there. Institutional owned, 79%. PE ratio, not a good start here, Chase. It's a 70, double the industry at 31. Price to sales, also expensive, 9.5 versus 2.6. Price to book value, 13.3. That is better than the industry at 20.5. And price to cash flow checks in, expensive, 61.4 versus 17. The PEG ratio does look good, which means you're paying a lower amount for the future growth of the company, 3.4 versus 14.9. Now, here's probably why the stock is so expensive. Well, last year, their earnings grew by 365%. The industry was down 1.1, but that could be coming off a very, very low base, very easy to grow those lower earnings as opposed to higher earnings when you get more established. Sales were up 32% versus 6.8. I believe they're opening restaurants, so that would increase your sales as well. They do not pay a dividend. Look at the balance sheet. Current ratio is good, 3.0 versus 1.1, so a lot of liquidity there still. Debt to equity, no problem, 0.6 versus 1.0, so that's a positive. Net profit margin, well, this is a good number. It's 13.7% versus 8.3, so they make about 14 cents in every dollar they bring in, so I'm glad to see that. Return on equity is 19.6. Industry down 413, and return on invested capital is at 12.5. And they do have a small amount of free cash flow, about 51 million versus 3.6 billion for the industry.
Current price here for CAVA Group, again, their ticker symbol CAVA, CAVA, $83.43, 52-week range. Wow, this stock has been crushed. The 52-week high, $172.43. The low here is $70. And this company, I mean, the whole concept is people are buying it because they think, oh, it's going to be like the next Chipotle. And I mean, they are growing nicely. They did report 10.8% sales growth at comparable locations, also known as comp sales in the first quarter. But it actually maintained a full year projection of just 6 to 8% improvement in that category. So it seems like those sales, again, are slowing down, which is going to be a problem. And I'll tell you why. You go forward for this company, you go out to December 2026, estimated earnings per share, just 72 cents, gives you a target sell price of $11.95. It trades at over 117 times those future earnings. You have to get growth here with this type of valuation on CAVA. I mean, and to have 6 to 8% growth on comp sales, I don't think is enough to justify nearly 120 times multiple on those earnings.
And I did look the analysts. I mean, they were 90 days ago, 87 cents. So they're down about 19%. So they're not seeing good things that's going forward. And I'm trying to think why. Do they see a slowing economy? I don't think that tariffs would have any effect on restaurant food. I don't believe so. So I think the analysts, there's 11 of them, could be saying, yeah, this could get hurt in a slowdown in the economy, which we don't think is going to happen.
Yeah. We don't think, we think the economy is going to slow but not decline, essentially. And this kind of reminds me, you remember the company Shake Shack?
Yeah, I remember Shake Shack.
Shake Shack had a bunch of hype back in the day, too. And I remember when they came out, and I'll tell you, the stock has done okay, but I was kind of curious because there's so much excitement around it. The 10-year return on Shake Shack, 41%.
What?
Yeah. I mean, you haven't done that.
It's been out for 10 years.
Yeah, it's been out over 10 years.
Wow.
But again, people thought they were going to make all this money like they did with Chipotle. And we've talked about this so many times where people, they miss the Chipotles of the world and then try and find the next Chipotle and they think it's Shake Shack and then you end up with a 10-year return of 41%. I think CAVA, I mean, they could do very, very well. They're going to have to grow very nicely. Everything's going to have to go right for them. But with that valuation, I think your 10-year return from here is going to be quite limited.
Yeah, it sounds like it. All right, we'll take a quick break here. When we come back, we got our financial planner, Harrison Johnson, talking about who benefits from the new SALT proposal. We'll talk about that. And also we got First Solar, Levi, Strauss, and UnitedHealth. Stay with us. We'll be right back. Alrighty, welcome back to the Smart Investing Show. This is where we do the financial planning segment, helping you understand and be educated more in financial planning, not just investing. For that, we bring on our CFP, Harrison Johnson. Harrison, thanks for being here today.
Always good to be here.
We're talking about who benefits from the new SALT proposal. Went through Congress, so it's passed Congress.
Passed the House.
Oh, the House.
Yes.
Okay.
Now it's going to the Senate.
Now it's going to the Senate. Okay. I call Congress the House.
Yeah, Congress is the House plus the Senate.
Yeah.
Really?
Yes.
You can go back to civics class.
I guess I have to. Gosh, I've been so busy reading these financial reports. I need to get back to that. All right, so it passed the House. I think something will go through Senate somehow. But it's important to know what this is because I think it sounds pretty good. But I want to get your opinion, see what you think.
Well, we'll talk about the numbers first, and then we can talk about our opinions on it. But the way that I'm talking about the SALT proposal here. So right now, there's a $10,000 cap on your state income taxes and property taxes if you itemize on the federal side. So the new proposal has now made it through the House and it likely will change when it gets through the Senate. But it increases that $10,000 cap up to $40,000. So state income taxes and property taxes now have that $40,000 cap, and then depending on your income, your ability to use that full $40,000 starts to get phased out when your total income goes above $500,000, and it's totally phased out down to that $10,000 limit when your income reaches $600,000. So that's the way the numbers work. Again, this isn't now going to the Senate, so there probably could be some changes, but to increase from $10,000 up to $40,000 on the SALT deduction.
And I think this is going to benefit a lot of, I'm going to call middle income workers. I don't think that it's on the high income side. It's a good income, obviously $600,000.
Depends on where you are. I mean, California. I mean, yeah, mid income definitely is kind of in that level.
And New York probably, and
New York, New Jersey, and California were the representatives that were fighting for this. Yeah,
but I think overall it's going to put more money in people's pocket. But there are some negatives to it, like you talk about the phasing down and SALT. I think Chase, you told me like SALT, and I thought it included property or interest. What pepper? No, that's too spicy for me. I don't like spices. State and local taxes.
Yes.
Yeah, it doesn't include the mortgage.
Which I thought the mortgage. Yeah.
So yeah, and that's the component of it that matters, because in order to get a benefit, you almost need to have a mortgage, because another thing that's happening is the standard deduction is going to be increasing, it looks like. Right now, for a married couple in 2025, the standard deduction is $30,000. So, when we talk about a $40,000 SALT cap, you're not starting at zero. In order to itemize or get any benefit itemizing, your itemized deductions have to be larger than the standard deduction. And the standard deduction looks like it's going to be increasing to $32,000 for a married couple, which means to really get a benefit, you need that SALT deduction somewhere between $10,000 and $40,000. Plus, if you have mortgage interest that's deductible with higher interest rates, you can have $30,000, $40,000, $50,000, $60,000 of deductible mortgage interest. With the $10,000 cap, it was really hard for people to itemize, because that $10,000 added to whatever mortgage they had was in many cases not enough to get over that $30,000 limit. But now people with mortgages are going to really, I think, see the biggest benefit. Number one, they have to have the income to be able to qualify and afford the mortgage. If you make $50,000, you're still not going to be itemizing. This won't have an influence on you. But I think for those people with incomes, maybe $150,000 to $200,000 on the lower range, and then up to $500,000 to $600,000 on the phase out with mortgages, in high tax states are going to be the ones that see the biggest benefit from this.
Yeah, I mean, I think I've been on the record, and I think it might piss some people off, but I just really hate the SALT deduction. I think it's the stupidest thing.
What?
And again, I'm a Californian, but if I'm in Texas, if I'm in Florida, it's like, why are we giving this benefit? And I mean, in theory, you could have property taxes that could be up to that $40,000, but very unlikely that is the case, since real estate's not as expensive out in Florida and Texas. So why are you paying higher taxes essentially on the federal side in Florida and Texas to subsidize the deduction for Californians and people in New York? It has just never made sense to me. And, that's a little bit maybe more of my political beliefs than an investment or financial planning front, but I hate the SALT deduction.
And I get your point as well. And I know, like, you bring up Texas and Florida. Think about Arkansas. Think about Alabama. I think their houses, I think you buy a house in Arkansas, I'm guessing around $100,000.
Yeah,
so they get no benefit. So it is a good point you bring up.
Mm-hmm. I mean, there's lots of ways to look at it. I mean, we are residents of California, so, we have the property taxes, we have the state income taxes, but you're right. Essentially, we are being subsidized by residents of lower tax states. But I don't know. This would help me personally. This goes through, so.
Well, you're the financial planner. That's why. but one thing we talked before on air, we were talking that I was surprised that there's no separation whether single or married.
Yeah. So the $500,000 phase out between $500,000 and $600,000, that applies for both single filers and married filing jointly filers. So usually when you go from a married down to a single filer, your benefit is half as much. But in this case, it's still the same $40,000 limit, single or married filing jointly.
And I'm just wondering, people saying like, you know what? I love you, but I'm not going to marry you because I could not pay more tax. I think we talked, maybe you'll.
It depends, because if you have two people who are both single and not married, then they file under the single tax brackets. So maybe they might be able to get larger deductions if they both owned homes and they both had income, so they could both potentially get up to a $40,000 SALT deduction, both be able to itemize, but their effective tax rate filing as a single tax filer is at a higher rate than what it would be if it was married filing jointly. So, I mean, I'm sure there are cases where it would make sense to not be married, but then there's other cases where it does make sense to be married, and then, be in those joint tax brackets.
I know we have clients that they're both doctors. You going to recommend they get divorced to save on taxes?
Well, they
make too much money.
They would probably benefit by not being married. Yeah. For two high income earners, the way that the tax brackets work on the single side, you climb up the brackets quicker. So two high income earners, if you have two people that both make $1 million a year, they're better off not being married. And that's before, this SALT change or anything else.
And I think the ones you're talking about, they're moving to Florida anyway. So.
yeah, they are. So.
But even making $500,000 each, I think it'd be benefit. And again, we got to do the numbers to see.
Yeah, I think so. Yeah. There is a threshold, and it's $1 million definitely. That's a safe number that I threw out there, but yeah, $500,000 each probably would be enough to.
That's your job as a financial planner to say, okay, I know you want to get married, but it's going to cost you about another $30,000 in taxes.
Yeah, I mean, I have looked at that before. What is because in other cases it is helpful to be married if you have a high income earner and then a low income earner, or usually if you're in different tax brackets, it's helpful to be married because essentially the high income earner can move some of their income into the low earners tax bracket, and it brings down the effective tax rate. So for most people, getting married is a financially good thing on your taxes, period. There's other maybe not so good financial things that can be a result of it. But
all right. Well, Harrison, thank you very much for the update there. Keep us posted on that. Again, that's Harrison Johnson. He's our financial planner. He is a CFP at Wilsey Asset Management. If you want a free consultation with him, give him a call at the office, 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. And you can send them an email, set up that free consultation to find out how financial planning can save you on taxes, get you that plan, do the right things, opposed to just, like a ship with no rudder.
Yeah, just going about your day with no direction. And I was going to say, too, we're going to talk a little bit about solar here up next, which going to talk a little bit about this tax bill. But I want to be very clear. Harrison talked about it a little bit. But this tax bill is still very early in the books. And as you said, it's got to go to the Senate. The tax bill that passed the House, well, they had some concessions made. So I can almost guarantee you that through the Senate, there's going to be some more kind of back and forth that's going to have to occur. So very unlikely this bill is the final bill.
Oh, yeah, there's going to be changes to it. So talking about the bill, let's go to talk about First Solar, which got hit, what's it, Wednesday?
Thursday.
Yesterday.
And it actually,
Thursday.
It got hit, but not as bad. And what happened is through this bill, the legislation actually ends tax credits for installers of solar that lease equipment to customers. The bill also ends the investment and electricity production credits for clean energy facilities that begin construction 60 days after legislation is enacted or enter service after December 31st, 2028. We're talking about First Solar here. They were hit by about 4 or 5%, but Sunrun, an actual installer, they were down like 40% on Thursday. So, I mean, that was a major hit to them.
And I think I heard the year 2028 that goes in effect.
For parts of it. So it seems like the installation from Sunrun, they're going to get hit pretty quickly here. And that's why First Solar didn't get hit as hard, as they're actually not installers. They make solar panels, and they actually didn't have their manufacturing credit. That was unscathed. So they are still a benefactor of, I'm going to call it the Inflation Reduction Act. That didn't change for them. They're still benefiting from tax credits.
And I know this came out a couple of days ago, but I do see that maybe this happened recently, but the shorts on First Solar is 13.2%, which above 10%, we get kind of concerned that there's some problems there. First Solar, their symbol is FSLR. They do have 97% institutional ownership. Gotta love the PE ratio. It's a 13.5. The industry has no PE ratio because no earnings out of the industry average there. Price of sales is expensive, though, 4 versus 1. Price to book value, 2.1 versus 2.8. Price to cash flow is 49.7 versus 71.7. And the PEG ratio looks really good, 0.2 versus 0.8. So you're not paying very much at all for the future growth of this company. Now, with last year, earnings for First Solar are up 23.4%, which is very good. But the industry is up 77%, and sales for First Solar, now they were up 19.4%, but the industry only up 0.7%. So that growth in earnings in the industry could be something else kind of crazy there. Gotta love this, and this could change going forward because of recent things that are happening here. 5-year estimated growth rate from the analyst was 43.1% for First Solar versus 18.6% for the industry. My guess is we could see that come down because that's just very high. But good growth rate there. Let's take a look at the balance sheet. Current ratio is 1.9 versus 2.1. That is good. Debt to equity, wow, only 0.1 versus 0.7 for the industry. So not much debt at all at First Solar. We do see that they have a net profit margin, very good, 29.7%. Industry a negative 14. Return on equity 15.5% for First Solar versus 9.5 for the industry. Free cash flow for solar, unfortunately, a negative 900. I believe this is, I'm going to say billion.
900
million. Must be million, right? Industry 500 million. So that's not good. We like free cash flow companies that are positive.
And I did look at that a little bit on the free cash flow, and what's happening is they're having a lot of capital expenditures currently. This year for 2025, CapEx is estimated around $1.24 billion. So they're investing a lot in the business right now, which is producing that negative free cash flow. And free cash flow is your cash flow minus CapEx.
Yeah.
Now, that CapEx is expected to fall off materially. So 2025, analysts are projecting free cash flow of negative $472 million. Not good, obviously.
Right, and CapEx is capital expenditures.
Mm-hmm.
Yeah, be in mind. What's
2026, though, because CapEx is expected to kind of fall off, they're looking for free cash flow of $1.39 billion, and then 2027, they're looking for free cash flow to expand even further to $2.24 billion. So it seems like this capital expenditure ramp that they've had is really kind of on the back end. This is one thing I'd want to know if I was looking at buying the stock, because that could be all of a sudden now a cash-generating machine here over the next couple of years.
And that means buying back stock, maybe paying a dividend, which they don't now. So, yeah, that's a good point to bring up.
Yeah, and the other thing I like about First Solar, too, it is basically U.S. company predominantly. They have manufacturing in the U.S. and in India, but about 90% of their sales take place in the U.S. And then India is their next largest market. Let's see, 2024, they had sales there of, 201 million. So it's a much smaller part of the business. It is a U.S. business. As I said, they primarily sell to businesses too, and utility projects, things like that. They're not selling to residents, where I think even the changes in the tax code potentially is not going to stop an Apple or a Microsoft or these other companies that want to be green and care about carbon footprint from stopping the solar expansion. I think this is much more isolated than a Sunrun type company as well. But let's look at the numbers. I mean, as you can tell, I might be a little bit excited about this one. Kind of looked ahead here, but the current price for First Solar is $158.38. 52-week range, the low here, $116.56, and the high, $306.77. It's really kind of been lumped in with concerns over, I'm going to say, the green spending and that slowdown or the shift that may occur under the Trump administration. But this is what is very intriguing. You got to December 2026, estimated earnings per share here, $24.14. Gives you a target sell price of $400.72. I mean, it trades at about 6.5 times those 2026 earnings. And this is crazy too. This year, earnings are estimated to grow 28%. Next year, they're looking for earnings growth of 56%. Again, I think they are having this investment cycle start to wind down a little bit, and they should start profiting on an earnings basis and a free cash flow basis over the next few years.
And I think you also said, too, I mean, looking at your notes there, that this company doesn't just sell to homeowners, but for big businesses.
They don't sell to homeowners.
They don't sell. So you can't get, I mean, the solar panels, they make none for homeowners?
They had discussions with Sunrun about a potential partnership, but I guess even the modules that they currently make, they're not really ideal for homes. Or, the big solar fields, they really work with utility companies. They said Apple was one of their big customers. So, they're not really selling to homeowners, which I think is the market that's going to get hit much harder.
So, like, businesses want their solar panels on the roof, or it's a big project is what it is.
Mm-hmm. Over the solar fields. Yeah. But the other thing, too, that I looked at, I know we're kind of short on time, but I wanted to bring this up because let's even say the IRA was removed, right? The manufacturing credits that this company would get. First Solar is expected to receive about $700 million to $1 billion annually in what's known as PTCs, or production tax credits, once its new factories are fully ramped. If you remove that completely, so it goes to zero, well, that would actually hit them pretty hard, as it could cut earnings as an estimate by around 33 to 50%. But I look at this and saying, well, it trades at 6.5 times earnings. You kind of have this margin of safety built in. Even if the IRA was removed completely, First Solar would still be a profitable business, which I was pretty amazed by.
I do see this 30 analysts, big range on the earnings. So $14.90 at the low side, $28.46 on the high side. So that does give me a little caution there.
I guarantee. What did I say? 50%. So one person might be saying that, hey,
Yeah.
You're going to lose a lot of the IRA, which I don't think is going to happen because President Trump wants manufacturing here in the U.S. That is why they're getting these tax credits, is because they're manufacturing the solar panels in the U.S.
If it does only earn $15 a share going forward, that's still a PE of 10.
Yeah, I mean, it's a good value. I mean, I'm very surprised by the valuation of this business.
Yeah. Well, I think it's worth watching.
I think it's very intriguing. I think it's an interesting business that could do very well here.
Okay, let's move on to a retailer here. We're talking about Levi Strauss, and I used to wear those jeans. I don't wear them any longer, but I know a lot of people do. They're in the industry of apparel manufacturing. Short is only 6%, no problem there. Institutional owned is 86%. PE ratio, decent start here, 19.7 versus 21.5 for the industry. Price to sales is the same as the industry at 1.1. Price to book value 3.5 versus 2.8. Price to cash flow 10.7 versus 9.3, and the PEG ratio is very good, 2.3 versus 20.2. So not paying too much for this company compared to the industry. Now there's something going on here. The earnings over the last year were up 200%. So they probably had some write-offs the previous year, or they had some big gain that was non-operational, something there. Industry was up 22.4. Sales for Levi Strauss grew at 5.9% over the past year. The industry was down 1.1%. And the analysts got a 5-year earnings per share growth estimate of 7.6%, pretty good compared to the industry at 2%. I do like to see that they pay a dividend, 2.9%, use 57% of their earnings to pay that out. Look at the balance sheet, current ratio, is 1.5 versus 2. I'm okay with that. Debt to equity 1.1 versus 1.8. That's okay as well. We do see a net profit margin of 5.6 versus 4.5. Usually retailers don't have a big profit margin, but that's pretty good at 5.6%. Return on equity 17.5 versus 19.7. And they have free cash flow of $442 million. That is about half the industry at $820 million. But I'm thinking this is okay. I guess it's going to depend on what you find for the earnings going forward.
Yeah, let's take a look at those numbers here. Levi Strauss, again, their ticker symbol LEVI. Levi, nice and easy. I said we picked some easy companies here today with CAVA, ticker symbol, Levi, ticker symbol there. I mean, nice and simple. But again, their current price is at $17.74, 52-week range. The low, it did hit $12.17, and the high here is $24.34. This company looks interesting. And I say that because going out to November 2026, estimated earnings per share of $1.36 gives us a target sell price of $22.58 and be an estimated return of about 27-28%. So our margin of safety is 30%, not quite there yet.
Right.
But, I mean, it's an interesting business. And the thing that I like about Levi, we like the CEO, Michelle Goss. I think she does a great job with that business. And she is really hyper-focused, I think, on the Levi brand. And they recently announced they're selling their Dockers brand for about $311 million. And it's not a big deal to them, but it really illustrates her emphasis of the business of focusing on the company and I think driving Levi for profitability. And I found this interesting. Dockers was founded in 1986 as a hedge against denim and to kind of offer khakis.
Oh, really?
But khakis, people don't really wear anymore.
I was saying, because I remember they were a big thing. It was in the 90s. I forget when it was. And like, oh, Dockers, I've not heard that name come up at all. And when you said Dockers, I was saying, is that a shoe? What is Dockers? I can't even remember what they were.
But again, she's really focused on saying, well, that business isn't, they did about $67 million is what Dockers did in the first quarter. So, I mean, it's not really worth, I think, the time of the company to invest resources, invest people, invest marketing dollars into that. I think they'd be far better off, again, focusing on their core business, which I think is what Michelle Goss is doing there. And I like the move. I think it'll be good. And I think the numbers look okay. I think Levi's, it's an interesting one.
And I know Michelle Goss. She's been on Wall Street for a while. We like her. What her style is, what she does. So I mean, at the right price, and I still think that there's going to be more of a pullback here this summer. This could become a buy with a pullback of 10% or so, maybe. Mm-hmm. So pretty good. All right. Well, let's move on to, let's see, our next company is, I was going
to say, speaking of a pullback.
Right. And it's kind of funny when you look at this company. I mean, it's just like you kind of cringe a little bit, but that could be the time to buy. And you don't want to buy a company or invest in a company when everything's great, because you're going to pay the full price for that. You want to find a business that is having trouble, that is, as we always say, is a fixable problem that can be fixed in the next couple of years or so. And we're talking about UnitedHealth Group. Their symbol is UNH. They're in the healthcare plans industry. surprising with all this the decline in the stock. The short's only 1%, so people aren't shorting this stock at all. Maybe it's all the bad news is out already. Institutional ownership is 91.4. Good PE ratio 12.4 versus 13.7. Price of sales 0.7 versus 0.4. Price of book value 2.8 versus 2. Price of cash flow checks in at 9.6. That is below the industry at 10.8. And you have a PEG ratio going forward of only 0.8. That's half the industry at 1.6. So some good value here appears to be there. Now, this is amazing, and I think this will be changing going forward. But earnings over the last year are up 45.8% for UnitedHealth versus 20.5% for the industry. Sales for UnitedHealth climbed by 8.1%, industry up 5.1%. The 5-year earnings per share growth estimate, and this is fresh, just came out this week, still at 16.3%. They're still seeing some good growth here. Industry's at 14.3%. They pay a nice dividend, 2.8%. They use 35% of their payout ratio. I'm not sure. One thing I question with all the problems they're having, will they cut that dividend? I've not seen anything yet. We don't follow this company, but what I've seen so far, I've not heard any major financial problems where they cut the dividend. So you may collect a dividend while the stock continues to fall, perhaps. We do send the balance sheet. Current ratio 0.9 versus 0.6. That is good. Debt to equity is also 0.9 versus 0.8, so that's positive. I do see a net profit margin here in line, 5.4, actually better than the industry at 2.8. Return on equity is 23.3 versus 18.7 for the industry. Wow. The cash flow just is double the industry. It's 24.8. I'm pretty sure, well, that's billion.
Yeah.
That is billion. The industry's at 13.5. So this company is a cash generator. So you may be getting a lot of free cash flow. And I remember reading, cash flow can be so important for a business to grow that business over time. This company has that cash flow.
Yeah, and I mean, looking at the current price, I mean, this is really where it's interesting. It's $295.57 again for UnitedHealth. Their ticker symbol UNH. 52-week range. I mean, we know it's been beaten up. It's actually not at the 52-week low quite yet. Essentially, the 52-week low is $248.88. The high, though, $630.73. Year to date, the stock is down about 42%. So I mean, it's just been hammered. And this is where it's intriguing. I mean, now with the company, and I remember looking at UnitedHealth, and it's like, well, it's an interesting business. It was always like, well, it's kind of fairly valued.
Right.
I don't think it was ever like at 25 times earnings or anything. It wasn't egregiously overpriced. But now you go out to December 2026, you see it's at estimated earnings per share of $26.75. I mean, you get a target sell of $444.05. It is trading around 11 times earnings. But the thing that is, I'm going to say concerning, is, I mean, they've had so many problems.
Yeah.
Just to list a few here, this past week, actually, the Centers for Medicare and Medicaid Services announced an aggressive expansion of Medicare Advantage audits. So if they're not doing things properly, well, that could actually hurt the profitability of that particular part of their business. Then also, too, I thought this was interesting. There was a report that came out. The company made secret payments to nursing homes to reduce hospital transfers that added, again, further issues. Then there's a Department of Justice investigation. Then their CEO stepped down. Then they pulled their full-year guidance. And actually, this is kind of almost backwards, not
Right.
in chronological order. But then we also talk about last year they had a cyber attack that hit, I think it was millions. 190 million people is what their cyber attack was impacting. And then you had, obviously, the CEO of UnitedHealth, the insurance division, that got murdered. I mean, they've had so many problems in the last 12 months. I mean, this is like a 10-year window of almost concerns, not 12 months.
And you say, well, bad things come in threes. Well, I think they've had more than their fair share.
Yeah.
And that could be why the CEO stepped down. Like, I
just
can't
can't handle it. Yeah.
Yeah. I mean, they've got some bad luck coming through that's really hitting them. But this could be, again, that's when you want to buy a company if the fundamentals make sense. And I don't remember the stock hitting 630. I remember at 400. I think we kind of looked at it like, yeah, it's a little bit pricey. I never saw it go to 630, which it did obviously hit. But I mean, there seems to be some potential here with it. You gave the earnings down the target sell price already? What was that?
Yeah, the target sell price here was $444.05, so it trades at around 11 times earnings. But I did want to say as well, the other thing with UnitedHealth that is always a little bit confusing is, I mean, they have health insurance, they have a PBM, but they also are kind of in more businesses as well. They have like a doctor's network. I mean, they have Medicare Advantage. I mean, they have more business lines than a traditional health insurance company. And sometimes that worries me because there's, I'm going to say, maybe potential waste. There may be potential areas of government concern. I mean, there's more to research on this business, to say the least.
Wow. I got surprised by that closing bell. I thought we had more time left, but we don't. So thank you for listening to Smart Investing Show. It is for informational purposes only and should not be used as investment advice. Let's discuss in more detail your investment needs or have other investment questions. Give myself a call, Brent Wilsey or Chase Wilsey at 858-224-0004. Again, that's 858-224-0004. Or go to the website, smartinvesting2000.com. Again, that's smartinvesting2000.com. We got the newsletter there. Sign up for that. A lot of other great information there as well. Thanks for listening. We'll be back next week.